Hey everyone, welcome back to the channel. Let's dive straight in and get right to the heart of today's lesson. Today I'm breaking down a crucial skill for any Forex trader: how to spot potential buy and sell signals using candlestick patterns. We'll explore how these patterns can give you an edge in the market. Now, if you're an intermediate trader, you already know that candlesticks aren't just pretty charts with different colors. They are so much more than that. They tell a story, a real-time narrative about the tug-of-war between buyers and sellers, and the resulting price action in the market. Each candlestick represents a battle. But here's the million-dollar question. How do you translate that visual story, those candlestick formations, into actual profitable trades? How do you know when the story is signaling a potential buying or selling opportunity? Let's walk through it step by step, and I'll show you how I analyze candlestick patterns to identify potential trading opportunities. We'll break down the key elements and how to interpret them. First, before we get too deep, let me get this important disclaimer out of the way. It's crucial that you understand this. No single candlestick pattern, on its own, guarantees a win. The market is far too complex for that. But, and this is a big but, there are certain patterns that, when combined with the right market context and a solid understanding of support and resistance, can seriously improve your trading edge. So, with that said, let's start with buy signals. We'll look at some of the most reliable bullish candlestick patterns. One of my personal favorites, and a pattern I use frequently in my own trading, is the bullish engulfing pattern. Imagine a scenario where the price is clearly trending downwards, making lower highs and lower lows. Then, suddenly, a small red candle, representing continued selling pressure, is immediately followed by a large, powerful green candle that completely covers, or engulfs, the previous red candle. That's a clear sign of buyers stepping in with significant force, indicating a potential shift in momentum. But, and this is crucial, don't just buy blindly the moment you see this pattern. That's a recipe for disaster. I always, without exception, check to see if this pattern is forming at a strong support zone, or perhaps after a significant down move that may be exhausted. The more supporting context you have, the stronger and more reliable the signal becomes. Context is king in trading. Another very reliable and frequently observed pattern is the hammer candlestick. Picture in your mind's eye a candle with a relatively tiny body located at the very top of its range and a long extended lower wick or shadow stretching downwards. This pattern visually demonstrates that sellers initially attempted to push the price significantly lower, but buyers aggressively stepped in and slammed the price right back up before the candle's close. I particularly like to see hammer formations appearing at the tail end of a defined downtrend, or precisely at a crucial and well-established support level, getting confirmation on the very next candle. For example, a solid green closing candle makes the buy signal telegraphed by the hammer pattern even stronger and more compelling. Now let's switch gears and move on to identifying potential sell signals in the Forex market. One of the first patterns to look for when anticipating a potential sell-off is the bearish engulfing pattern. This pattern, as its name suggests, is essentially the opposite of the bullish engulfing pattern we just discussed. It consists of a relatively small green candle indicating some initial buying pressure, immediately followed by a large and dominant red candle that completely swallows it up, engulfing the previous candle's body. This is a strong indication that sellers are decisively taking control of the market narrative. And, just as with buy signals, location absolutely matters. Specifically, if this bearish engulfing pattern forms at a well-defined resistance level, or after a significant upward price rally, that's your cue to sit up, pay close attention, and consider a potential short position. And finally, don't ever forget to keep an eye out for the shooting star candlestick pattern. This particular candle formation is characterized by a small body situated at the very bottom of its trading range, coupled with a long upper wick or shadow extending significantly upwards. The shooting star pattern suggests that sellers aggressively stepped in at the top of the price move and forcefully pushed prices right back down towards the bottom. I always watch very carefully for these shooting star formations at the end of a sustained uptrend, or when the price reaches a key and previously established resistance zone. And, as with the hammer pattern, if the very next candle confirms the shooting star's signal with a solid red close, that's a very solid and reliable sell signal for me. So, with all of that said, here's the golden rule to remember when using candlestick patterns in your trading. Candlestick patterns are undeniably powerful tools for understanding market sentiment, but they're definitely not magic wands that guarantee instant profits. Always, without exception, look for additional confirmation of the signals that these patterns are providing, whether it's through volume analysis, the use of moving averages to identify trends, or a thorough understanding of key support and resistance levels in the market. So, the next time you find yourself staring intently at your Forex charts, don't just passively see the candles, actively read them, interpret their stories, and understand the market sentiment they represent. Let the candlestick patterns guide your trading decisions, but always remember to use smart and disciplined risk management techniques to protect your capital. That's all for today's lesson. Happy and profitable trading to you all.